Welcome to Commerce Sensei. Today we are going to understand the flow of accounting. So, accounting helps businesses with money. It keeps records of finances and honestly, it's the language of business. This helps owners make decisions, They can see if they're doing well or if maybe some changes are needed. The job of accounting is to give useful information, especially about the business's money. Now, the accounting process actually starts pretty simply. It all begins with a transaction. This is really where accounting starts. Without transactions, there's no accounting at all. It's like the very first step, like the first brick laid, and all accounting builds on this. So understanding transactions is pretty vital, but what exactly is a business transaction? Well, it's a deal or an exchange where value changes hands between parties. For example, let's say a shop sells a nice book. The shop gets the customer's money and the customer gets the shop's book. That's a clear transaction. Both sides are affected by it. Here's another example. A business buys a new desk. The business pays cash for it and the supplier gives the new desk. Again, value has been exchanged. Cash was given for the desk. This is a business transaction and it must be recorded carefully. Not all happenings are actually transactions. Some are just business events. An event is just something that occurs. It might be important, sure, but no money may exchange hands then, or maybe there's no measurable value given. This difference is really important. Accountants only record transactions. For example, if a firm hires a new manager, that's an important business event, but no money is paid at that moment. So, hiring is not a transaction. Later, when the manager gets paid their salary, that salary payment is a transaction. Money is exchanged for work. Timing is key in accounting, and every transaction must have proof. We can't just guess numbers, right? Proof is extremely important, always. It shows the transaction is real and makes records accurate and reliable for everyone who uses them. This is a basic accounting rule. No proof means untrustworthy records. So, what kind of proof is needed? An invoice is a very common proof. A sales receipt is also proof. Bank statements show money details. These are called source documents, and they show the date, amount, and details of what was bought or sold. It's really important to keep these documents very safe. So, now we have a transaction with proof. Next, we must record it. The first book we use is called the journal. The journal is basically a business diary. It lists transactions by date, which is called chronological order. This way we can see what happened each day. It's the first formal record. In the journal, we write all the details, the transaction date, the accounts affected by it, and the amounts of money involved. Every transaction affects two accounts. This is called double entry bookkeeping. One account gets a debit and another account gets a credit. After the journal, the data moves on. It goes to the main ledger. The ledger holds all the accounts and each item has its own account, like a page for all cash, a page for sales, a page for rent, and so on. It groups similar transactions together, which helps summarize everything. The ledger shows account totals, like how much cash there is. The cash account shows this. Or what are the total sales? The sales account tells us. The ledger really summarizes financial data, making it easy to find information and check account balances. After updating all the ledger accounts, the next step is to prepare a trial balance. A trial balance is simply a list. It shows all the ledger accounts and their final balances, whether they are debits or credits. Its main job is to check the arithmetic. Do total debits equal total credits? If the debit totals match the credit totals, that's a very good sign. It suggests the math is correct and double entry bookkeeping has been followed. But some errors can still hide, but it's still a really useful check. It's done before the final reports and helps make those reports accurate. Next, we use the trial balance data to prepare the final accounts. These show the business results. First comes the profit and loss account. This account shows how much profit or loss a business made during a certain period. Imagine a shop owner asking, how much money came in and how much went out? All incomes are added together, expenses are subtracted, and what remains is the profit or loss. This helps owners understand, is my business doing well or do I need to make changes? Second is the balance sheet. The balance sheet is like a snapshot, showing what the business owns, assets, what it owes, liabilities, and the owner's share, owner's equity, at a specific point in time. Think of it as a photo at the end of the year, where you see, what do I have and what do I need to pay back? The balance sheet tells you about the financial health of the business, just like a doctor's report tells you about your health. In summary, the accounting flow is pretty logical. It begins with a real transaction, which must have clear proof. First, it's recorded in the journal daily, then posted to the ledger accounts. A trial balance checks the arithmetic, And finally, both the profit and loss account and the balance sheet together make up the final accounts. These final accounts give the business owner a clear picture. How strong is my business and what can I improve? So, this is the last step in accounting and also the most important. Like and subscribe Sensei for more such commerce-related videos.